Welcome, I'm the Options Overlord. Today we run one stock, Intel, through the options first screen. This is not a buy or a sell call. It's a method. Are its options pricing enough movement? Let's read it. Data captured as of week ending 14th of August 2026. Verdict first, then we earn it. Intel's premium reads fair, leaning slightly cheap. 30-day implied volatility is 64%, but the stock's own realized volatility is 79%. The options are pricing less movement than the stock has actually delivered. Hold that. That's the hook. Realized 79, implied 64. When a stock moves more than its options expect, you are not overpaid to sell that premium. Everything else today is context for that one gap. Before the premium, the business. Intel at $102.50, 27% off its high. Revenue up 25%, cash flow positive, debt manageable, all green. But return on equity is still negative and margins are thin. That's a watch, not a green light. A strong story doesn't remove event risk, and a weak one doesn't make the premium cheap. The clock that matters is earnings, about 60 days out, after the close October 22. The chart shows an implied move near 30%, but read it carefully. That's a multi-week straddle, not the one-day earnings move. Any premium you sell has to survive that print. The track record, 8 straight reports, all after the close, averaging a 9.3% move, from down 17 to up 24. 2 of the last 3 were double digits. So the earnings day expectation is closer to 9%, not 30%. This name can gap hard. Volatility, plainly. IV is the move options expect. Realized is what the stock did. Intel's IV has sat above its realized on only 38% of the past year. So this is a normal to low premium setup, not an inflated one. And the trap, high IV is not danger, low IV is not safety. IV is the size of the expected move, not the direction and not the risk. 3 risks. 1, the earnings gap. This stock moves double digits on a print, so short premium held through it is a bet on the gap. 2, horizon confusion. That 30% implied is multi-week, not the 9% one-day move. Match the number to the trade. 3, it's a turnaround. ROE still negative, 27% off the high. Improving, but unproven. Let that set your size, not your conviction. By lens, short premium, fair to slightly cheap. So keep size small and respect October. Long premium, not obviously expensive, but a poorly timed buy gets crushed after the print. Covered calls, if you owned it, normal pay, and that 9% average move is exactly the upside of call caps. Binary events, earnings is the binary, so anything carried through it is a gap bet. The part that works on any ticker. Compare IV to realized. See where IV sits versus the past year. Find the next event and its distance. Check the actual event move record. The Overlord rule, price the move, not the story. Options are only fair when they pay for the movement a stock actually delivers. Screenshot this. Verdict, fair. Leaning slightly cheap. IV 64, realized 79. IV above range 38% of the year. Average earnings move 9%. Put call open interest balanced at 1.03. The whole read on one card. The wrap. Fair, leaning slightly cheap. Normal to low priced options on a stock that moves hard. The edge, if any, is in how you structure and size around that October earnings gap, not in the premium being rich. This is method, not advice. Run the same screen on your own names. Educate, discipline, execute.